In this video, I'll make an introduction to budgeting. I'll take the federal government as an enterprise and coronavirus COVID-19 pandemic as a case example. Budget is a short-term, quantitatively expressed plan. It includes financial and non-financial aspects. It's a blueprint to follow in the upcoming period. Budget plan is a short-term version of the long-term strategy plan. Strategy plan arises from the strategy is the overall enterprise directions. The strategy plan is to accomplish long-term objectives and the budgeting plan is to accomplish short-term objectives. An enterprise has resources and there are opportunities, and some run into the long term and some can be accomplished in the short term. The plan that is prepared, if it is a long-term plan, it is a strategic plan. If it is a short-term plan, it's a budgeting plan. If it is a budgeting plan, then short-term resources are deployed to accomplish short-term opportunities and objectives set. Both plans have gaps. Strategy plan, when current resources don't match with the long-term goals based on opportunities, there is a strategy gap. When current resources don't match with short-term objectives based on opportunities, then there is a budget gap. Budget plan tells where to direct resources, often financial, to where it needs most to accomplish opportunities. So objectives is at the center. There are 4 aspects or dimensions to it: time period, then the income forecast, the cost or expenditure forecast, and the resources are available and deployed to accomplish objectives. Opportunities and threats arise in the environment. Here I've taken Australia, the federal government, as an enterprise where there's an opportunistic or economically active environment. In that environment, there's net immigration, there's booming Asian economic environment, higher prices for coal, minerals, metals, resources are produced in Australia due to the booming economic environment. Elsewhere, more inward tourism, more houses being built due to economically active environment and net immigration, more property transactions, and more consumption. These opportunities allow government to earn more revenue, and much of the revenue comes through taxes. The government can collect more company tax through high resource prices and more economic activity. Can collect more income tax due to more employment and more economic activity. More consumption of goods and services tax due to more net immigration and more economic activity in the environment. Other fuels, excise, customs duty, Medicare levy, superannuation taxes, fringe benefits tax, all these contribute to earning revenue. When there's more trade, more wealth, where people contribute to superannuation than its threshold, and when there is more economic activity, more taxes can be collected. Government also has expenditure. A major expenditure is social security and welfare. There's health, education, defense, general public services, and any other expenses not covered as above. Opportunities and threats arise in the environment. Government as an enterprise can face threatening or economically passive environment. For example, the coronavirus pandemic, the COVID-19 pandemic, and the recent bushfire. The same variables can exist. There can be net immigration by slowing Asian economic environment, low prices for coal, minerals, and metals due to less demand, less inward tourism, fewer houses being built, fewer property transactions, and less consumption, and there's less net immigration due to border closures. When opportunities allow more revenue against expenditure in the budget plan and the budget activity, that leads to a budget surplus of favorable variance. The budget objective is a net cash surplus, and the key performance indicators of that objective are outlined here for underlying cash balance as percentage of gross domestic product, unemployment rate, tax to GDP percentage, and net debt. The threats in the environment can make government to earn less revenue through taxes. It may collect less company tax due to low resource prices and less economic activity, collect less income tax due to pressure on employment and less economic activity, collect less consumption tax due to less net immigration and less consumption, and also collect less other taxes due to less business activity and less economic activity. Government can have more expenditure under adverse environments. Social security and welfare expenditure can increase, health expenditure can increase, education costs can increase due to school closures or adjusting times, or due to alternative ways of pedagogy that was not envisaged due to and also it can increase defense expenditure due to border closures, and general public services also can increase due to the residents looking for various public services due to changes in the adverse environment. There are other expenditures that the government will have to incur. For example, the bushfire recovery package was $76 million, and the combined stimulus and safety packages on the coronavirus pandemic amounts to, for now, $189 billion. That's 9.7% of the gross domestic product. The environmental threats can decrease revenue and or increase expenditure than the budget plan and the budget activity, and can erode a budget surplus and leads to an unfavorable variance. For example, the budget objective of the federal government was accomplishing a net cash surplus, and that can be under threat. The key performance indicators of that objective can have adverse outcomes, such as lower underlying cash balance as percentage of GDP, higher unemployment rate, lower tax to GDP percentage, and higher net debt. The environmental opportunities and threats can have a budget impact, and some of this budget impact can be intercepted by other interventions. I've noted here 7 interventions. The first one is the Reserve Bank of Australia decreased the cash rate to 0.75% with an aim to inject liquidity to the economy. Second, Banking Association announced 6 months loan repayment deferrals for small businesses to keep them afloat. Third, Big Four banks announce 6 months pause on mortgage repayments for those who are holding residential properties. And fourth, access to government benefit criteria are flexed and payments amounts are increased for those who fall within the safety net and who can become unemployed as a result of this coronavirus pandemic. Fifth, access to superannuation funds based on a certain criteria and they can be accessed tax-free to a certain limit. And six, increased cash payment to employing small and medium-sized businesses and not-for-profit enterprises. It waives the asset test, the time test, but income test is still on. Changes to bankruptcy laws to assist businesses to get through the difficult period. Some enterprises have a master budget. It is the overall budget plan. There are various ways to prepare a master budget. The design is what fits the best to the enterprise. There are three aspects to consider. It's the resource planning through the budgeting, and then the resource control for value creation through management control, and taking responsibility for resource use through responsibility accounting. A master budget can be prepared by functional areas in that the functional areas will prepare their budgets, sales budget, production budget, purchase budget, human resource budget, and in the center is the financial budget that integrates the functional budgets to a holistic master budget. Steps followed in preparing a budget plan. First, prepare the revenue budget. Second, prepare units of production budget. Third, prepare the cost of production for material, labor, and overhead. Fourth, prepare the budget for unsold goods or ending inventory. Then fifth, prepare the cost of production budget. And sixth, prepare the income statement budget. This brings us to the end of the video. Thanks for watching. Professor Indra Besekara. In this video, I will outline benefits of budgeting. There are three benefits of a budgeting plan. First, to communicate directions and goals of an enterprise. Second, to judge performance by comparison, plan versus actual performance. Third, to motivate staff to accomplish enterprise goals. Let's look at communicate directions and goals of an enterprise. There are four approaches, and these approaches are contextual to an enterprise. I've taken here the strategy perspective. First, top-down approach may be suitable for enterprises following a stable or defensive strategy. Second, bottom-up approach may suit enterprises following a growth strategy. Third, top-down negotiated with the bottom approach may suit enterprises following a stable strategy. Fourth, bottom-up negotiated with the top approach may suit enterprises following growth and stable strategy. Communicate directions and goals can be viewed from enterprise type. First, top-down approach may suit enterprises that are following command control approach. Second, bottom-up approach may suit enterprises that are knowledge intensive. Third, top-down negotiated with the bottom approach may suit enterprises that are growing. Fourth, bottom-up negotiated with the top approach may suit enterprises where staff have ownership of the enterprise. The second benefit is to judge performance by comparison. To judge performance by comparison in a budgeting plan, first, the budget should set objectives. Second, should identify objectives by key performance indicators. Third, revise the key performance indicators to meet the actual realities. Fourth, compare with the plan with the actual. The third benefit is to motivate staff to accomplish goals. There are self-objectives of the staff member, and there are enterprise objectives that needs to be accomplished. The staff member could be internally driven to accomplish goals and could be self-directed. If the staff member is not internally driven to accomplish the enterprise goals, then externally driven to accomplish enterprise goals that should be directed by external stimuli such as rewards. The benefits of a budget plan comes with several challenges. First, motivating staff members. Staff members have self-interest and enterprise has its own interest. To maximize benefit, the two types of interest should be reconciled. Second, gaining commitment. At the budget formulation stage and in the budget approach, often in the bottom-up approach, where the staff members' input is considered, can offer a gaining commitment. Third, changing budgets with changing circumstances. The environment keeps changing, the enterprise environments keep changing. Therefore, the planned budgeting might not fit the actual realities. Therefore, the budget has to be updated regularly to ensure that the actual realities are considered. These challenges are outlined in motivational theories. I'll consider these three theories here. The first one is Maslow's hierarchy, which is a need-based theory. The second is the Herzberg's two-factor theory, where there's motivator factors and hygiene factors. The third is the goal-setting theory, which is about setting challenging and clear goals. In Maslow's hierarchy of needs theory, one needs to identify the staff members' present situation and offer motivations to reconcile the self-interest with the enterprise interest. The basic is the physiological, where the staff member wants to meet the physiological needs such as food, shelter. Second is the safety, where the staff member's priority is about security. Third is the belonging, where staff members' priorities are about relationships. Fourth is self-esteem, where the staff members' priority is about prestige. Fifth is self-actualization, where the staff member is looking forward to accomplish full potential. Herzberg's two-factor theory, they identify factors in two categories, motivators and hygiene. The motivator factors cause intrinsic satisfaction, and hygiene factors causes extrinsic satisfaction. Under the motivator factor, the challenging work, meaningful work can cause intrinsic satisfaction. Under the hygiene factor, job security and job status can cause extrinsic satisfaction. The third is goal-setting theory. In this theory, the goals should be set for the staff, and those goals should be clear, challenging. The staff should be committed to those goals, should have some complexity in task, and should provide feedback to the staff. The overall goals to be accomplished by the enterprise begins with a vision statement, which sets the overall goals supported by the mission and value statements. The long-term strategic plans sets the long-term objectives, and the short-term budgeting plans sets the short-term objectives that are meant to meet the long-term strategic objectives. The long-term strategic plans sets long-term budgets, quantitative objectives, and key performance indicators. Short-term plans are short-term budgets, sets quantitative objectives and key performance indicators. This brings us to the end of the video. Thanks for watching. I'm Professor Indra Sekar. In this video, I will outline budgeting methods. There are 4 budgeting methods I'm going to outline: incremental, activity-based, zero-based, and Kaizen. These budgeting methods can be looked at from different perspectives. I'm going to look at from cost perspective here. Incremental budgeting method looks at previous performance as preceded. It's useful when cost drivers are static. Activity-based budgeting method allocate resources to activities. It's useful when cost drivers and activities are identifiable. Zero-based budgeting method, it is where each item is included and is justified in the budget plan. It is used when there's urgent need for cost containment. Kaizen budgeting method is about continually improving processes and costs. It intends to accomplish efficiency and there's cost justification, which is a key focus. The budgeting methods can also be looked from an enterprise perspective. Incremental budgeting. Previous performance is a precedent. It is suitable for government departments. Activity-based budgeting. It allocates resources to activities. It's useful for manufacturing industry. Zero-based budgeting method. It is where each item is included and justified. It's useful for industry sectors with low profit margins such as food and beverage. Kaizen method of budgeting is about continually improving processes and costs. It's useful for industry sectors with high fixed costs such as automobile. Incremental budgeting, you start with actual performance, then the variances are analyzed, new budget is prepared, the cost and revenue often are adjusted for inflation and enterprise improvements. It sets new objectives and key performance indicators to compare with actual performance. Activity-based budgeting analyzes activities that lead to cost and revenue. Unnecessary activities are removed to save costs. Necessary activities are included even if costs increase, but if that results with increased revenue. Zero-based budgeting is where each item that is included has to be justified. Starts with actual performance, then it justifies new budget items. New budget is prepared with quantitative plan and then sets objectives and key performance indicators for the budget plan prepared. Examples of enterprises using zero-based budgeting are Kraft Heinz and Unilever. Kaizen budgeting finds smarter ways to improve processes and procedures. It focuses on how activities are conducted rather than what activities are conducted. The budgeting looks for internal improvements and also external improvements, such as supply chains, value chains are important. Examples of enterprises using Kaizen budgeting are Nestle and Toyota. There are variations of these budgeting methods. Some are also unique to enterprises. For example, an enterprise could start with profit and work backwards to come up with a budgeting plan with the intention of achieving or accomplishing targeted profits. This brings us to the end of the video. Thanks for watching. I'm Professor Indra Abhisekara. In this video, we'll look at our responsibility accounting. Why responsibility accounting be included in the budgeting? Staff are one of the vital assets in enterprises. The responsibility accounting track the resource use, those are the costs, and resource creation, those are the revenue, through areas of budget responsibility. The focus is not about functional departments or the manager, it is about which resources the manager has control over. The responsibility is passed on to lower management and hold them accountable in the responsibility budgeting. Typical responsibility centers are cost centers, making a product. Traceable costs are direct costs, for example, in a production department. Second is a revenue center, where products are sold. An example is a marketing department. Third is a profit center, doing both buying and selling, or producing and selling. It could be a branch, division, in a chain such as a retail chain or restaurant chain. Investment center is making project investments to maximize productivity, use its own cash surpluses for better returns. An example of profit center is the effect of price beating can offer price discrimination. In Bunnings advertise as find a lower advertised price and we'll beat it by 10%. The price guarantee discourages competitors to discounting and promoting. An anti-competitive slogan that says "Do not steal our customers" can bring all customers into a store Australia-wide in Bunnings, can sell at lower prices to those who care about the price, and can sell at higher prices to those who do not care about price by differentiating products. An investment center is PHP Bulletin, where they use the capital allocation framework. In that framework, the operating cash flows is considered for three aspects: cash investments, maintaining strong balance sheet, and for shareholders. In relation to cash investments, the cash is considered for organic growth projects and exploration or acquisition. To maintain strong balance sheet, cash is considered to reduce debt and maintain assets. For the shareholders, BHP Billiton return 50% of earnings as dividends, and any excess cash is considered on share buybacks. Responsibility accounting encourages feedback on responsibility undertook and executed by those centers. It helps in three ways: giving early warnings, assisting in performance evaluation, and evaluating strategy. Responsibility accounting is accurately analyzed by flexing the budget plan to actual situations. It is to look at actual units for the budgeted costs, actual units for the budgeted revenue, actual units for the budgeted profits, and actual units for the budgeted investment. If you look at a responsibility center and look at the volume and the price, there is the budgeted or the standard volume and standard price, and there can be variations in volume and the price, and the actual volume and actual price can be compared with the standard, and the price variance in relation to standard price versus actual price can offer an explanation, and the volume variance in relation to standard volume versus actual volume can also offer a volume variance. It is important to flex the budget to actual situations, become far more realistic in the comparison. Responsibility accounting can help diminish budgetary slack. It is underestimating revenue and overestimating costs. There are 3 ways to overcome budgetary slack. First, use external performance benchmarks. Second, use rolling budgets to update the current budgetary position. Third, use bottom-up budget preparation that is then negotiated with the top management. The responsibility is associated with control over enterprise costs, revenue and activities. Costs, revenue, profits and investment has more variation over longer time period. Regular and frequent reviewing helps to get the best benefits of responsibility accounting. This brings us to the end of the video. Thanks for watching. I'm Professor Indra Besekra. In this video, I will outline management control in relation to budgeting and responsibility accounting. An enterprise can have a budget plan and introduce responsibilities for accounting for the budget plan, but resources are central to implementing the plan. When we look at the management control as a system of operations, it becomes different from other systems. The strategic planning system focuses on a set of long-term objectives and develops a long-term plan for enterprise operations. Budgeting planning system sets short-term objectives, develops a short-term plan for enterprise operations. Internal auditing system monitor efficiency of enterprise operations and compliance with policies and safeguard enterprise value. On the other hand, management control system review the resources to implement operations such as a budget plan or strategic plan with a view to create enterprise value. So management control systems can recommend various techniques to execute the budget plan to create enterprise value. They can fall into 3 categories: costing techniques, risk management techniques, and quality management techniques. Management control systems can recommend various techniques to execute the budget plan to create enterprise value. They can be identified by three categories of techniques: costing techniques, risk management techniques, and quality management techniques. For example, in costing techniques, it could be by using of activity-based costing or target costing. Risk management techniques, it could be about sensitivity analysis. Quality management techniques, it could be about total quality management. Management accounting versus financial accounting. Management accounting and financial accounting differ. For example, management accounting focuses on customer, whereas financial accounting focuses on sale. Management accounting focuses on supplier, and financial accounting focuses on expense. Management accounting focuses on value. Financial accounting focuses on profit. Management control system creates enterprise value in different ways. First, differently costing for different purposes. It could use absorption costing for one purpose, variable costing for another purpose. Managing risk not only internally and externally through supplier chains and value chains. Managing quality through relationships and experiences of customer. Here's an example of the Ritz-Carlton creating enterprise value is by managing quality. It's called the art of the craft, satisfying customer with extraordinary experience. It's by providing personal service with a difference, and their staff aim to be that difference. They welcome the customer by name, extend private dinners to customers. Chef come out and present a specially prepared plate to the customer and wrap the evening with music, wine to make it a great experience to the customer. This brings the discussion to the end. Thanks for watching. I'm Professor Indra Basic.